Global banks shocked as collapse unfolds. Silver keeps rising. Commercial real estate is set to fall here in the United States. And now we see this has a domino effect, taking down countries we thought to be immune, crashing by 64%. 64%. I'm going to break this down for you and show you how this directly impacts silver and gold, this silver that we've been so excited about this past week, these metals that we've been watching so closely. This article is titled, Paris Office Sales Fall to Lowest in 15 Years. We're going to start in Paris and head around the globe to watch government economies, counting the minutes as this collapse unfolds. Again, Paris office sales fall to lowest in 15 years. This is frightening because we're watching people all around this globe struggling with commercial real estate. When people insist on holding transactions at a specific price level, things start to plummet. Governments they absolutely depend on tax revenues from these buildings. And that's why these central banks and governments are shocked. Now, this article states total deals for properties, including offices, retail space, and warehouses in the greater Paris area, sink 64% from a year earlier. This is the lowest quarterly level since the second quarter of 2009. Yes, you heard that correctly. 2009. This is dangerous, of course, for landlords, and it's specifically dangerous for all these governments that rely on tax revenue. It is going to only get worse, especially when we see references to 2009. That is when we're coming out of the global financial crisis. That was 2009. That's when we're coming out. Presently, we have not even gotten into a recession yet, and we're seeing transactions and values completely plummet. This is not isolated to Paris. We saw this week it's happening in Germany, China, of course, here in the United States. Governments will need to cut spending as tax revenue falls, or else banks will go out of business in a large way. If you're enjoying this video, hit the like button and subscribe. Help get this information out. I really appreciate it. So this article tells us in the greater Paris area, the average cost of buying office space slumped 19% from a year earlier in the first quarter. This is the lowest price in almost 7 years and far below the peak achieved in 2021. In France, total investment deals plunged 55% in the first quarter. This tells us that governments are going to be required to cut, and political elites hate to hear that. When people do not need office space, that means landlords are going to lose revenue. That's the bottom line. Banks are going to be put under serious pressure. This can all be quite confusing when we see headlines like this from Bloomberg. This is from Bloomberg. The headline says, Summers says job data show neutral Fed rate is much higher. The article says this was a hot report that suggested that, if anything, the economy is re-accelerating. Alongside other factors, including epic loosening in financial conditions, it seems the evidence is overwhelming that the neutral rate is far higher than the Fed. It goes on to say the neutral rate is the theoretical level from the Fed's benchmark that neither stimulate nor restrain growth. Fed policymakers last month estimated it at around 2.6%. That's their neutral rate. The median estimate of their forecast that's 2.6%. This author says that the neutral is 4% or higher. That compares with the current target rate of 5.25%. This, of course, is confusing. The Fed raised its short-term rates higher than the market has those rates priced at, which means they inverted yield curves and curves that constrict the creation of credit. Now, that is a game of quantitative and easing and quantitative tightening. That the frightening part about this balancing act that the Fed is trying to perform is that it is happening on the largest scale known to us. Nothing of this magnitude has been pulled off, and these cycles of rate hikes have never occurred so quickly and on such a grand scale as what we're going through presently. Could you imagine if the Fed raised rates even higher? I mean, according to Summers, according to this article, the Fed does not need to cut much. If in the next cycle, the Fed will be back to zero because we were there twice. We've been there twice. The concept that we are being told is that we're in a new world of high rates, and this is the new normal, right? We just need to accept that's the idea. They want us to think that as these banks begin to hemorrhage, as this ever-pressing issue of commercial real estate and failing regional banks, as it all comes down and unfolds, the only answer will be zero. This article shows Earlier this week, Jerome Powell reiterated his skepticism, moving out the idea of using estimates of a neutral rate as a guide for policy. The question of what the neutral rate will be going forward doesn't really matter for policy today. That's what he said. Look, we know that if the Fed admitted that they did their math and the neutral rate is wrong, it would highlight the myth of the Federal Reserve System because they have no clue what the neutral rate is, and they need to constantly adjust it as needed. So, as Summer said in this article, it's important to have a guidepost in setting current policy. There's no way to judge what policy is without knowing what would be a neutral policy. Saying we don't need to know what the neutral policy rate is like saying you should drive your car on feel without looking at the speedometer. I mean, really, if central bankers understood the bond market, which they don't, they would never put the curve in an inverted state. That would let the bond market dictate everything. They would do that, right? As we live through this issue of commercial real estate, I see consumers turning to credit card debt, and you and I, we don't turn to credit cards, especially after this week of record price in metals like I'm holding here. We in general, we as a silver stacking community, we are very skeptical of debt in general and everything that encompasses this debt-based society. And that's why, as this all unfolds, this issue of commercial real estate in Germany, France, China, in the U.S., interest rates are going to be manipulated as this rolls out. The dollar is going to be impacted, and that means that precious metals like this, silver, right? The price of metals is going to go even higher, and that's what keeps me. Again, I'm just a regular guy stacking silver. I'm not a financial advisor. I'm just telling you my opinion. When I see all of this going on, all this uncertainty, all of this disruption, that tells me that metals are not only are they the safe store of wealth, but that they are the smart store of wealth. Because look at what we're experiencing this past month. Prices going up, silver finally moving, following gold, just like it's supposed to. And that's exactly what we're going to see. As all this plays out, what this article is showing us is that what happens in the United States is also happening in Germany, it's happening in France. Clearly it's happening in China because China's commercial real estate is even more of a nightmare than we have here. China has been building and building these towns and villages and cities in the hopes of people, even without demand. They were like doing it in reverse, right? They're creating this infrastructure without the demand, hoping that people would move in, and now it's not happening. So here in all these countries, as we see all of this unfold, it's the same thing is going to happen, right? And interest rates are going to be manipulated, and the dollar is going to be impacted clearly. And as we stack and stay the course and stack metals like this silver here, right? As we stick to it, and I really see, if you want to know what I see in my crystal ball for the price of silver, I'll tell you. I see silver headed for a real correction. I think it's gonna dip a little, and then it's gonna level out. And when it does, that's when I'm gonna really be picking up silver. Right now, I'm waiting. I'm letting it go up. I'm letting it fluctuate a little. Let it go up. And as it levels out, that's when I'm going back in. And again, I'm not an advisor. Like, I'm just telling you, that's my opinion. I'm just a regular silver stacker. Okay, let's continue this. This article says now. The question is, what could tip the global economy into recession? So looking at the commercial real estate market, that is a disaster. We look at consumers turning to credit cards as a huge red flag. Why are people turning into credit cards? Oil prices are rising, and this is exactly what we saw during the global financial crisis. Oil prices surge, and hourly wages dipped. Now today, we see oil prices rising, and although hourly wages are strong, people are still turning to credit cards, which tells us that the math is incorrect. In the Bloomberg article states Canada unexpectedly shed jobs and unemployment rose to 6.1% in Canada. And this Bloomberg article says The country shed 2,200 jobs in March, and the unemployment rate rose 0.3 percentage points